There are so many people that can't square what is happening in the economy, in the world, in healthcare, and what's happening with the stock market. And that's the overwhelming question. There certainly is a difference, Mark, between the two. And that is probably the biggest question. As we went into this thing, there were so many unknowns. And you can just talk about the virus, for example. We didn't know how bad it was going to be. Did we have testing? Were we going to overwhelm the healthcare system? Were we going to have therapeutics? All of that stuff is now more known to us. And that is really, when we talk about investing, we try to get as much information as we can.
Well, that's certainly the point. I mean, whenever you think about the stock market or volatility in the markets, you can just take a look at that VIX, for instance, the volatility index. That number got up to be around 80.
If you remember, I'm sure you do, a couple of months ago, we were telling our clients we want to see that VIX come down. We saw it in the 20s this week.
That's right. And then we even saw it come down to the 40s and then to the 30s and then to the 20s, and you start to get more clarity. But when you have that much uncertainty, when that VIX is showing you that, you have to then take a look and say, are there grades of outcomes here where you want to be really cautious about this, not to go completely to cash, but to take something off the table, perhaps take risk out of the portfolio. And I think that sometimes when you're dealing with,
or reduce the risk of the portfolio,
to reduce some of the risk out. And when you're dealing with a financial plan that's a long-term vehicle, you can take a little bit of that risk out when you have that much uncertainty.
Well, you can reduce the risk, Derek, and that's really what we're doing. We're risk mitigators as well as we're asset managers.
That's right, because when you build an asset allocation model, you're looking at the valuation of a variety of asset classes in and of themselves, on an absolute basis, but also relative to other asset classes. And one of the things that obviously has supported equities really in the last 5-6 years is the low level of interest rates. The dividend-paying stocks and companies that have great business models and are growing earnings at a faster rate than the S&P ought to perform pretty well when interest rates are low. In fact, one of the things I thought was interesting this week is there actually was a Fed governor who was positively considering negative interest rates. Now, I don't have to tell you what that would do for dividend-paying stocks. They'd look even more attractive. So generally speaking, interest rates have been a supportive factor. Fed liquidity has been a supportive factor. And the only real negative has been the uncertainty about the trajectory of the economy. And I think that remains to be seen.
That's for sure. And it can be bumpy. Some of these cyclical stocks that we're seeing rally this past week, airlines, hotels, and energy, I found so surprising. But, if people are building portfolios, we are seeing a barbell effect.
Yeah, we are. I mean, clearly the cyclical names that you just mentioned had been just thrown out with the bathwater in February and March. Some of these stocks down 80, 90% from their highs. And yet another group, the companies with really nice balance sheets and dividends like Johnson & Johnson and Procter had held up very well. Tech names like Microsoft and Apple did the same. And what we've seen the last couple of weeks is those types of stocks, the ones that had held up the best, are kind of languishing. They're not really going down, but they're not fully participating on the upside. Many folks, I remember David Tepper said he felt that group of stocks were overvalued, fully priced in his view. So what we needed to see for the market to move higher was for the things that had been beaten down to rally. Well, they've done that as well, which is why I think active managers, looking at your portfolio, doing a rebalance, just assessing what your exposures are is a really good thing to be doing at this time of year, particularly as the political uncertainty starts to rise. The Chinese tensions haven't gone away, and we don't know whether we're going to have a second wave.
And by the way, you mentioned David Tepper, but Leon Cooperman, and right down the line, we're talking about Warren Buffett, for example.
Warren Buffett sold banks and airlines right on the lows, and Warren Buffett didn't sell them because he thought they were doing great.
Right, exactly right. Derek makes a great point. This is going to be a bumpy ride. I mean, it's not in a straight line. Trees don't grow all the way to the sky. There's going to be something that people have to do. They know that they have to have a portfolio review, but it has to fit into their tolerance for risk and their long-term plans.
That's an excellent point, because I think that people have to be reflective right now and think about what this has done to them and their financial plan. And how did you feel about it? I mean, did you sleep at night? Were you losing sleep when you got your March statement or your April statement and wondering, what are you going to do next? That risk tolerance piece, the portfolio review is the result of the risk tolerance, right? They have to go hand in hand together. In order to build a model portfolio for someone that fits within their financial plan, it starts with an idea of risk. And that comes with some challenging questions. And that's where we start with a number of the tools that we use in every one of our offices with every one of our clients, is to challenge you through an exercise to build a risk score.
And Mark, it's funny when we do this with couples, because it's often different between the husband and the wife. Sometimes they look at things differently, and that's the reason why we go through this exercise. We put it down, we measure it, and then it's interactive. And from time to time, we'll put these numbers on the screen, and we'll say, what if, what if, what if? And those are the two things that we put together for every client: a portfolio review and a framework for a financial plan.